Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey. Thanks for joining the show this morning. We got so many things to talk about this morning. We're going to talk about the Consumer Price Index, inflation, what's going on with that, home sales, S&P 500 companies, talk about interest rates rising, how that's going to affect them, and Chase, so we're going to talk about some other things as well.
Oh, always here to mainly take your calls, too. If you want to join the show here, phone number is 833-288-0973. Again, that's 833-288-0973. And we still think there's a lot of value out there in companies that you can find. So great opportunity to call in and see what we think about some different companies, see if there's good value in those businesses.
And again, you got to search and hunt for those companies. And we always tell people, give us a call for that second opinion on what you're kind of looking at. But we always kind of recommend call us before you do the buy. A lot of people, they do the investment, then they call us. It's like, well, call us first if you want to. And we'll give our opinion of it.
And it's so interesting. It makes me think of a quote from Warren Buffett. And I don't remember the exact quote, but I just know his saying is that, basically investing is a zero-strike game. You can't strike out. Right. So you don't have to swing at everything. And, we always tell people, we spend so much time looking at companies, and I'll tell you, sometimes it's frustrating. We miss the company because It went up. That's a bummer. But the nice thing is there's thousands of other companies you can look at after that. So don't feel rushed like you feel like you're going to miss out on something, and that FOMO, fear of missing out, really drives us to make poor decisions. Just be patient. Make sure the numbers look good. Make sure the business fundamentals are there before you jump into that company.
Exactly. That phone number is 833-288-0973. That's 833-288-0973. We'll take calls about 15 minutes. A lot of things to talk about. First of all, we got to talk about the Consumer Price Index. And even with all the fear, the consumer is still shopping. In October, retail sales were up 1.3% compared to September, and up 8.3% compared to October 2021. Now, this outpaced the inflation rate. October CPI report, which saw prices grow 0.4% month over month and 7.7% year over year. There were definitely areas in the retail sales report that benefited from higher prices as sales as gasoline stations were up 17.8% compared to last year, and grocery store saw sales climb 8% during the same time frame.
And then just for reference, this is why sales at those two areas were up so much. You look at the CPI, it showed gas prices climbed 17.5% year over year. So people are still consuming about the same amount of fuel. You're just paying more for it.
You can tell that on the freeways. Freeways are always packed now.
I know, exactly. And then also, too, you look at the food at home prices. Those were up 12.4% year over year in the CPI report. So actually, you look at that compared to the sales, people are getting less because they're having to pay more. That's a problem. Also, we looked at other areas of strength in the report compared to last October. Food services and drinking places up 14.1%. Gosh, that's true. I feel like I go to restaurants, they're always packed. Non-store retailers up 11.5%. And building material, garden equipment, and supplies dealers, those were up 9.2%. The only two areas that saw declines were department stores, which fell 1.6%, and electronics and appliance stores, which saw a decline of 12.1% as well. Two potential catalysts for the report included an additional Amazon Prime Day in the month, and also, too, can't forget about the distribution of the inflation relief checks, and I put that in quotations for you there, of up to $1,050 in California. I hope that we don't see additional stimulus like this going forward, as I believe it could create even more problems with inflation, as it would, again, create that artificial demand, as there's just too much money in the economy. We talked about the M2 levels. There's enough money in the economy to get us through this difficulty. We don't need to pump more into it.
That inflation relief check, wasn't that based on your car registrations or something? Well, how did they come up with that number? Because I didn't see my check in the mail. Did you?
You don't get one. Based off income.
Oh, okay. Well, all right. I don't know anybody that got one. Do you?
Yeah. I know.
Some of your friends?
Yeah, some of my friends did get it.
Yeah. What do they do with it? They invest it?
No.
No.
I don't know what they did with it.
They bought stuff. Okay,
Yeah,
that's kind of what it's supposed to be for, I guess. So let's talk more about some good news on inflation. This morning, well, actually this past week, as the October producer price index climbed 0.2% compared to last month. This was below the estimate of 0.4% and resulted in a year-over gain of 8%. It's crazy to think that an 8% increase is good news, but the numbers are decelerating.
And then in September, the year-over-year gain was 8.4%. And back in March, you can't forget the report showed a gain of 11.7%. So, again, it's not super exciting. We're at 8%, but we're also not near 12% any longer. The other thing here, too, is if commodity prices can stabilize and even perhaps decrease slightly, and if we stop pumping, again, so much money into the economy, I continue to believe inflation will be much less of a problem in 2023. And if you notice, much less of a problem, it's not going to not be a problem.
And what is important is many times not the number. Yeah, it'd be nice to have 2 or 3% inflation again. That's not going to happen for a while. But what we're looking at is the change of inflation as opposed to escalating up higher, pulling back lower. And we have said we believe by December, which will come out in January, the report, that we could see 7, maybe below a 7% inflation number, which will, again, in the right direction, means the Fed can kind of pull back on their raising interest rates, which means that we can do a little bit better, I think, on the equity side.
Well, I'm very curious as well as, you could have a huge December if CPI comes in slower than anticipated. Mm-hmm. Because I want to say, I know the Fed meets in the middle of December. I don't know the exact date of when CPI comes out, but I believe the market right now has priced in another Fed rate hike of 0.5%.
And one thing I'm looking at, too, because you said that gas prices climbed 17.5%. They have pulled back a little bit from the level that this report came out.
And we also started, this inflation, again, started last year.
Right.
So especially in the commodity prices, in the gas prices. We've been dealing with high gas prices now for quite a while. The issue was when we looked at CPI, and we've talked about this before, but when you looked at 2020 compared to 2021, well, yeah, there was a huge increase. But now, I'm just going to say, I don't know the number off the top of my head right now, but, gas was at, let's say, $2.50, and then it jumped up to $3.50. Now we're at $4.
Yeah.
Well, that's a much slower gain. That's not going to be as impactful as it used to be.
Right.
It's still impacting people, don't get me wrong, but it's
less of an impact.
Less of an impact in terms of the growth rate that we'll see in CPI.
And that makes you feel better because you really don't remember, maybe gas price. Remember, I was paying $3.75, now I'm paying, $4.75. You might remember that, but it still feels better than paying $5.75. And you feel better, you go out and spend more.
I still remember I paid $1 one time on the way to Arizona. That was so cool.
What was this?
That was during COVID.
Oh, COVID. Oh, yeah. Why nobody's on the road either.
It was like, oh, wow, it cost me $17 to fill up my tank.
Now you can say, oh, yeah, those were the days. Now that you're older, yeah, those were the days. Let's move on to home sales because home sales marked down 9 straight monthly declines in existing home sales as there was a decline of 5.9% from September to October. With an annualized pace of 4.43 million units in the month of October, existing home sales fell 28.4% compared to October 2021 and registered the slowest pace since December 2011, excluding the brief drop that occurred during the beginning of COVID.
Yeah, that was such a weird time. Obviously, it's kind of toss that number out because it's not a real number, I'd say. So that is kind of concerning there. But the other thing, too, we look at demand has clearly taken a drastic fall, but supply still remains an issue. With just 1.22 million homes for sale at the end of the month, there's still just a 3.3-month supply at the current sales pace. And that's what's crazy to me is that sales pace has come down so much, and we're still not at a balanced market. Generally, you kind of look at a balanced market of around 6 months as considered healthy supply. But it's kind of funny, this 3.3-month supply, I believe that's getting close to kind of where we were pre-COVID.
Right.
Which was already kind of a difficult market anyways. But with prices still expensive and mortgage rates likely to remain high, I'm still expecting a weak housing market here in 2023.
And one thing that, and we read a lot about this, one thing I notice is that the home builders, there's a difference. If you own your home, the resale home, you say, I'm not going to sell. But if you're a home builder, you have to sell. You have to do something to get that inventory moving. And they account for about, I guess, 15% of the overall sales across the country on homes. They will have to lower their prices. And then there's going to be people that, will have to start selling their houses. We haven't talked much here on the show, but about Airbnbs, where if they're not producing, people are going to say, it's not working out, I'm going to sell it. So, and again, we're not talking next week. We're talking on the next year. I think you will see the inventory increase because of the new home sales, Airbnb. And there's some people that, I'm sorry, they can't get their home. Remember, it was about a year ago where we talked about how people, they got like this 3% mortgage rate and they're so happy. And then like younger people, well, I got to cut the grass. I got to do less maintenance. I don't like this. They might be saying, I'm done with this home. I just want to get rid of it. So there could be more supply down the road. I would not be surprised to see a normal 6% or 6 month supply in 2023.
Well, it's very interesting too. There's different kind of routes for living that people are going with now. I know there's J.P. Morgan actually announced a joint venture with another company as well, where they're build to rent.
Right.
So rather than building to sell, it's built to rent. And then, we've talked about this before, but, we were driving, we did our office Christmas photos this past week, and right off Friars Road there, another complex going up for housing, and it's like, wow. There's that huge one that's going right off the 15 up in like Carmel Mountain area. We just saw that one that's right off the 15 in Scripps Ranch. They're popping up, and that's a very small subset that, just on the way, essentially, we're in the studio down here by Friars Road. That's not that far, and that's just 3 that are pretty much going to be brand new. That's a lot of housing coming on in the market. And you kind of talk about the Airbnb. Well, those people may say, I'll just convert it to a long-term rental. Well, now that's creating more supply for rentals. That's going to have to push the prices down. This is why supply and demand, it works in every situation. Doesn't matter if it's energy, doesn't matter if it's housing. It always comes back to supply and demand. And right now, I think there's a potential for a lot of supply to come on in the market, maybe perhaps for the rental space, which could hurt demand for housing. And rents, home prices, they are a function of one another. You can't have low rents and high home prices.
No.
It just wouldn't work. That wouldn't make any sense to invest in homes at that point. So
it can be a lag sometimes catching up, but eventually everything will come back to the norm. Higher house prices, higher rents, but inventory, more supply, that'll bring things down.
I will say I do think there is some concern as well. I know we kind of talked about some of the other side about why maybe there's more supply to come on the market. But the other thing, too, is we did talk about interest rates. And before, people were like, I'm getting a great deal on selling my house and, I'm buying a new house. Well, it's like, you bought high and you sold, or you sold high and you bought high is the problem. Right. But the other issue is now people might be, I can maybe buy a house for cheaper, but I don't want to sell my house for cheaper. So that's kind of an issue that could be there. Not to mention, if you have a 3% mortgage rate, it's going to be hard to say, I want to sell my home and now buy a 7% mortgage on it. So there could be some impacts in terms of supply, but I think over the next couple of years, I think that will work itself out.
Right. And I think we'll have more of a balance going forward, because I think people will stay in their homes, but then they'll be doing like, let's remodel, let's put new flooring, let's, paint, let's do, different things. So that will kind of, I think, balance out the economy going forward.
Yeah, and I hate to say it, but, people die as well. There's going to have to be, that's going to be supply on the market. Talk about the home builders. There will be homes out there. And if those people selling their homes are selling at a lower rate, that makes your home less valuable.
Yeah. And we said it's annualized 4.4 million units. It would never be 0. They always going to be selling some homes. And I think back in the peak, I think it was like 7 million homes on an annual basis. Yeah, it was huge. So let's talk about S&P 500 companies, because as interest rates are rising, corporations are paying off debt to reduce expenses. The S&P 500 companies have about $9.3 trillion in debt, and with businesses performing well, they're sitting on about $2 trillion in cash, which is close to $500 billion more than these companies had in 2019.
Yeah, this will definitely strengthen the businesses even more, increasing the value of many of these companies. And, we kind of talk about the high interest rates for mortgages. I think you'll see these companies now not take on as much debt because the money's not as cheap.
Yeah, and also too, there's not much they can maybe do with it at this point in time, and we have talked about, we do see larger tech companies laying people off, but we still see your small, mid-sized companies saying we need somebody. We don't want to get rid of anybody. We want to find somebody else. Actually, at our firm, we're looking for a good operation assistant person, and it's hard to find. I gotta say this, I've called, I think, about 12 people now. 2 have called back saying, "Oh, no, too far to drive, not going to show up." One said, "No, I found another job," and I think the number is now 6 have not even showed up. Didn't show up.
Well, not even did they not show up. They booked a time. To come meet with us.
Right? Yeah. They that's right. They had a time to come, had the appointment, and just didn't show up, didn't call, didn't do anything.
Yeah, it's crazy. I mean, I think, I hate to say it, but I think that's the sign of still a strong labor market.
Yeah. It's hard to find that. I want that perfect person because they take care of our clients, and our clients are very happy with the people. We're very customer service oriented.
And we've said it too, but the idea of, the headlines now from these tech companies making, Amazon's doing a layoff. Oh my gosh, Amazon's things must be terrible, But there's so many other, I haven't seen anything from like the big banks.
No.
That's just they have announced. Actually, there's going to be the mortgage issue. The
mortgage issue, and I think mortgage banking.
Yeah.
Because there's not as many IPOs that came out. So I think that actually.
Investment banking. Yeah. So, and maybe I'm just trying to think of other sectors. And actually.
Maybe healthcare is strong.
Business
services. So there will always be some weakness somewhere, but I think overall, and you see the big headline like, Amazon's laying off 10,000 people. Oh, it's terrible. But you're not seeing that there's 100,000 mid-sized companies that are saying we need more people.
And that's where the JOLTS report comes into play. Yeah. If we were having, really mass layoffs across the country, you wouldn't see millions of job openings.
Right.
Companies wouldn't be laying off people to post a job opening.
Right. And we talked last time that the JOLTS report, the number went up when I thought it was going to go down. So we'll see that comes out.
Probably, I would have to assume. Next week's a holiday week, so it has to be within the next 2 weeks.
Yeah, we'll see it then. Phone numbers here: 833-288-0973. That's 833-288-0973. As always, get you through for that unbiased, no strings attached, fundamental opinion about what you want to talk about. I do see Dorian. Be patient with us. We'll get to you. I just got to talk about this because it's something that I thought was kind of good. We feel that the price of everything is going up, but there is one thing that I found that for nearly 40 years has stayed the same price, and that is a hot dog and a drink at Costco.
Since 1985, the price has stayed at $1.50. And also, they have not done any shrinkage to the product. You hear a lot about the shrinkflation. Right. Well, not at Costco.
Where's that Wendy's commercial? Where is the beef?
At Costco. But if you want a better deal than that, you can now head on over to Sam's Club and get a hot dog and a drink for $1.38. Save yourself, 12 cents there. To keep prices low, this is what the economy needs. More competition and more supply, not a reduction in demand. If we can figure out the supply side of the equation, we don't have to crush demand.
Right. And that'd be a big thing because that'd be so much nicer to do. But we'll see. We'll see what it's going to go.
We had a hot dog from Costco.
I have a long time ago. I remember they're not small. It's not like some of those teeny hot dogs. And actually, I guess what we should do is analysis here is go to Costco, measure the hot dog, taste the hot dog, then go to Sam's Club, measure the hot dog, taste the hot dog, see whose is better.
Yeah, because I was going to say I try and eat healthy, so I don't eat a whole lot of hot dogs. But I remember Costco's hot dog being quite tasty.
And that is for a drink, too, the hot dog and the drink.
Yeah.
Yeah, that's not a bad deal.
Oh, it's a great deal.
Yeah. So, all right, if you like these topics and you say, gosh, I didn't quite understand what they said, you want to get the newsletter that we send out. It goes out every Friday. Also, we talked about that FTX with crypto, some great information there. More on the housing market. We talked about Target, electric vehicles for ride-sharing companies. We talk about Home Depot. It's a free newsletter. Just go to our website, smartinvesting2000.com. That's smartinvesting2000.com. You can get that newsletter for free. And a lot of people love it because, again, it's very quick information that's just packed with great stuff to talk about.
And I'm going to leave people on a cliffhanger here because you brought up Target.
Yeah.
We talked about the amount of shoplifting that is costing Target's bottom line. The number was just mind-blowing, and I'm going to leave people on the hook there so they go sign up for the newsletter. I'll probably come out if somebody...
yeah. Somebody's going to give us a call.
Yeah.
Oh, you ruined the surprise. All right, phone number's here, 833-288-0973. That's 833-288-0973. Let's go to Inglewood and speak with Dorian. Dorian, you're on the Smart Investor Show. Brent Chase, how can we help you?
Well, good morning, Brent and Chase. I haven't called in for a while, but anyway,
where you been there?
My toaster, my bread toaster, it gave out, so I had to get a new one. So I went over to Target and I looked over all the toasters, and I bought this one called Hamilton Beach, and am familiar with the brand, and it's been around for a while, so it seemed to be high quality, and it works exceptionally well. Anyway, I said, wait a minute, what about this Hamilton Beach? Do they have a stock? And they do. The symbol is HBB, and I'm looking at it. The company was formed like in 1910, and they have a PE of 6, and they pay a dividend of 3%, and they have quite a range, but they make very good products, and they're very reasonable, and people are familiar with the brand. I think they merged with Procter Silex.
Well, and you kind of got me kind of intrigued here too, because I like what you talk about here. So I want to look at more numbers on this company because it is an interesting company. I don't think I've ever looked at this company, but this could be something I have interest in. Again, the company is Hamilton
It's quite
Beach.
Small. It's a small company. I didn't know it's that small.
Yep, see, that could be a problem. But the company is Hamilton Beach Brands. Their symbol is HBB.
Yes.
Yep. They're in the furnishings, fixture, and appliance industry. 3.1% short on the float. 43.5% institutional owned. And you're right. A PE ratio of 6 versus 18.4. Price to sales 0.3 versus 0.6. Price to book value 1.7. This is tangible book value versus 26.2 for the industry. Nothing for price to cash flow, so I'm surprised on that, and no PEG ratio going forward. Now, we do see their earnings did climb by 8.3% over the past year. That's well above the industry that fell 68.5. The sales did decline by 7.5% when the industry is up 23.6. I'm not sure why that is there. You're correct. They pay a 3.2% dividend. They only use 18.5% of their earnings to pay that out, so that's a big positive. Look at the balance sheet. Got a current ratio of 2.6 versus 1.5. Shows a lot of liquidity. Debt to equity 1.2. That's double the industry of 0.6. But at 1.2, I'm okay with that if they have good cash flow and are in the process trying to reduce that debt. We do see a net profit margin 4.8% versus 3.7, and return on equity very good 26.1 versus 14.6. Chase?
Current price here for Hamilton Beach Brands, again, HBB, $13.22. 52-week high, $17.15. And the low here, $9.18. So year-to-date, it's selling down about 5.6%, while the market's still down around 16%. And here's what you're talking about, Dorian. It is a pretty darn small company here, $183 million market cap. But looking forward for this business going to December 2023, I do see the estimated earnings per share is $1.95. That would give us a target sell price of $32.37. So the value is definitely there. The problem is there's only one analyst that's following it. Many times that's the issue with these small companies. One other thing, too, that I would want to understand a little bit more is I actually think I had a toaster from this company as well a couple of years ago. But I know Williams and Sonoma came out, and they had kind of a disappointing earnings report, and they cut guidance and so forth for their holiday season, and I think next year. Curious if they're operating in any similar space. Are they more high-end? I am assuming that this company is maybe more of a value-type retailer, not so much the Williams-Sonoma is going after the kind of higher-end consumer, but something to keep an eye on for that business are they having similar problems perhaps as Williams-Sonoma?
And one thing I was thinking, I was going to kind of look to see the income statement and see what they're spending on research and development, because one thing you have to kind of do is you have to come up with new products, because toasters are not very exciting. So what are they doing to make it more exciting? Unfortunately, I don't see an R&D line pulled out here. It's a very summarized income statement, but that's one thing I'd want to know is, like, what are they doing to keep in the exciting area? Because toaster's not that exciting, but I like the idea of holding
Well,
a
they
brand
make
company.
more than toasters. They make coffee makers. They make
Oh,
air
yeah.
fryers. They make about 20 different things. Kitchen appliances.
Yeah,
And what impresses me is the quality. They're mid price. They're well known, and they make really good products. People like them. It's kind of like a Ford F-150 pickup. It's a good pickup, and maybe there's ones that are better that cost more. But it's a good value, and people know that. And I got a heck of a toaster.
Right. And that's what I mean. And they do other products like coffee makers and stuff like that. They do those appliances. But all those, you've got to keep them exciting because, I mean, a toaster will last for, 10 years. So that's a long time. So you want to have new products that come out like, oh, well, this toaster does this and that. And they now have these air fryers. I wonder if they do the air fryers and stuff because those are pretty exciting.
And I do see here as well that they also have commercial products for restaurants, bars, and hotels. I'd be curious what the breakdown is for retail versus commercial because I would assume maybe the commercial could even be more of a stable business because you're getting a lot of volume on those appliances. Probably need to replace them more frequently than you do a household item.
I think
one thing I noticed, this stock, it sort of goes back to 2017 as if it was, made at that time. Even though the company was made in 1910, it's been around forever.
Mm-hmm.
The stock only has a 4-year history. So it's kind of a new company or something.
Yeah, it must have been private for years and then just decided to go
Somebody
public.
spun them off, yeah. And I was going to say that too, is that perhaps this could be a takeover target down the road from somebody. I mean, $183 million.
Yeah.
I mean, that's not very much there, but
So, in other words, what do you think? More information or throw a little money into it? What do you think?
I would think I like what I see. I mean, we wouldn't research it more because if we were to buy it, we'd end up owning probably 20% of the company or so. But I think for an investor that is smart, wants to spend the time to look into it, I think it could be a good company to hold because if we did it, we would move the market, drive the price up. But you buying, we'll just say 10,000 shares, $10,000 worth or whatever, you're not going to move the market because I like the concept. I like this type of business, but it's not going to go up, 25% per year. But I think it's just a great company to hold long term.
Yeah, and definitely a different business as well.
And you get that nice dividend, 3.2% dividend? That's still pretty good. Yeah. So
I want to make one statement. I live right by the SoFi Stadium.
Yeah.
And they're opening up this new Clipper Arena, which is across the street in like next year or something like that. But anyway, it's going to be $2 billion for the Clipper Stadium, and the SoFi Stadium costs $5.5 billion. So that's $7.5 billion in like one area. That's pretty big.
Oh yeah,
that's huge.
Yeah, that's huge. Yeah, I remember the cost of stadiums the first one years ago. Like wow. $1 billion.
Yeah.
Now, that's nothing. Well, Dorian, thanks for calling in.
It's the most valuable stadium in the world. I mean, it's the biggest one, $5.5 billion.
Wow. Yeah.
So anyway, we'll talk to you guys again. So we'll watch my toaster.
Okay, well, let us know how the toaster is working.
Hopefully, it doesn't go up in smoke.
Thanks for calling in, Dorian.
Right. Thanks again.
Okay, bye. All right, that does open the phone line 833-288-0973. That's 833-288-0973. And Chase, I mentioned that, because I do like companies like that, but you have to be so careful. And again, because we manage about $500 million. When we generally buy something, we're going to buy, we'll say $20, maybe $25 million. You got to be careful of not just moving the market up, but you got to remember, too, that if you want to sell, you can drive the market down. So you got to be careful of that. And that's why you also look at the institutional ownership. And I think it was, 47% or something, I think the number was. That could be, bad. So you really got to look at so many factors when you're investing into a business of how you can move that market or what you to expect from it. One analyst, what if he stops doing it?
I was going to say that's the big thing that we didn't spend that much time on is the one analyst. Like, as I was saying, I think the estimate, I, of course, clicked off of it, but, the one analyst had an estimate of $1.95. Right. The problem is if they run into some issues and the analyst's like, oh, gosh, that's terrible, he can cut it down to, 85 cents. And now that's the only person you're relying on, where if you have, I say I'd like to at least have 5 different analysts. That way you have maybe one guy saying, oh my gosh, the world's on fire, we got to get out of this company. They're going to make no money. But the other 4 are saying, you're crazy. Now you're going to have kind of a huge spread between the high and the low. Right. But at least you have different deferring opinions there rather than just relying on what one person has to say about the company.
And I will say that one analyst did raise his estimate from $1.75 actually 30 days ago to $1.95. So he is seeing some good things there on Hamilton Beach Brands. And it's one thing, too, that I kind of remember as a kid. That name has been for a long time, so it makes you kind of feel good. I remember there was one company I thought we got into. It was a sporting goods company. Maybe we looked at it.
Big Five?
Big Five, yeah. And it was a similar situation. I don't think we ever got into it, but it didn't really move that much. But I think their market cap, if I remember correctly, was like 300 million or something.
Yeah.
And sometimes your smaller companies just don't move because there's nobody talk about them or looking at them. I'm kind of, we got no calls. You want to look at Big Five real quick?
Yeah,
Is that
just
what you're
pulling
doing?
it up.
Yeah, let me see. Do you know what the symbol is for Big Five?
It's BGFV.
BGF. Did you remember that? You looked that up?
No, I looked that up.
Okay. Because I'm thinking, wow, you got a really good memory.
Not that good.
Yeah, but it's one. And again, they did very well. They were open through the pandemic. They did well. So I'm kind of curious what they look like at this point in time. So it's one that we kind of missed. And again, the company is a Big Five Sporting Goods. Their symbol is BGFV. They're in the specialty retail. Oh, they do have 25.2% short on the float. So
Wow.
that could be a problem. 47% institutional ownership. But here, this is what I'm kind of talking about. The PE ratio is 6.5 versus 22.6. Price of sales 0.3 versus 0.8. Price of book value 1.1 versus not material. No PEG ratio because I don't think there's any analyst going to give that to you. Their earnings, wow. 1 year down 56.8%. Industry up 51.4%. Sales down by 12.6%. Industry up 85.4%. You get a 7.8% dividend yield, and they use 48.8% of the earnings to pay that out. On the balance sheet, you got a current ratio of 1.6 versus 2.1. Debt to equity 1.1 versus 1. Net profit margin 4.3 versus 3.7. So the numbers look pretty good except for that short and some other things. What do you got?
Yeah, I mean, looking here, current price for Big Five, $12.88. I see the 52-week high, wow, $29.04. And the 52-week low is $10.23. So year-to-date down about 28%. Here's what we're talking about. Good memory here is the market cap, $285 million. Looking forward for Big Five, though, there's just, again, one analyst following it, but the analyst believes they'll make $1.37 for December 2023. What gives a target sell price of $22.74? Honestly, I'm kind of surprised how short people are on this stock. I mean, that's a huge short position, and I don't see this company going bankrupt. It looks like they have, cash flow, earnings. Their debt's a little high, but nothing that would, I think, cause a bankruptcy event within the next couple of years. It just seems like a weird company to short because there's not that many people following it. Why is the short position so high?
And because we always talk about the current ratio, which is your short-term liabilities versus your short-term assets for 12 months. That, as I said, is 1.6. Your quick ratio, 0.2. So a lot of that liquidity could be in inventory and accounts receivable and not cash. That could be the problem.
Yeah, no, that could be a big problem because I think it's all inventory, honestly.
You think so? Are you looking at the balance sheet right now?
I was trying to pull it up.
Yeah, they got 34 million in cash and equivalents. Inventory is 316 million. Receivables are 9 million. Yeah, so it's all in inventory, which is in a way positive because they got the inventory to sell. But if you have to liquidate, you're going to have to drive the price way down. So, so most of the liquidity is coming from the inventories at 316 million, which is, actually higher than, September 2022 years ago was like 255 million, but that was after the pandemic started. So
and it's got to all be inventory in the discrepancy because I just want to confirm the quick ratio actually does include accounts receivable as well. So that means that discrepancy is all inventory. That's a lot of inventory on the balance sheet.
Yeah. And I think that's mostly what they are. I don't think they own their locations. They're probably leasing those. I did notice too that their long-term debt is 222 million, which is not bad compared to their equity, but a lot of their equity is again from that inventory.
And I will say too, I know we talked about BJ's Wholesale several weeks ago, and it was.
Did you say they reported they didn't do so well?
They didn't do so well.
No.
I was going to say, it's just kind of funny when you're like, well, do you know anybody that shops at BJ's? No, not really.
They're more back east.
They are back east, but you even said your friend's back east. You're like, no, we don't go to BJ's. We go to Costco.
Costco.
It's same thing with Big Five. I don't even know where the closest Big Five is. I remember the last time I've been in a Big Five was about 10 years ago in Flagstaff, Arizona.
Right.
And that was the last time I was there because that's the only location I can remember. It was right off the college campus.
I know where two are. One is on Mesa Boulevard by the big Target.
Mm-hmm.
They have one there. And then there's another one over in Poway that is where the LA Fitness is. They have one there. And there's like a Dollar Tree next to them. And always people going. So,
yeah, I haven't gone there in so long. And the other thing that I will say is kind of amazing is you look at, the sports authorities that used to be around.
Oh, yeah.
They're gone.
Yeah.
And Big Five has lasted.
Yeah.
But, I mean, you're competing against Dick's Sporting Goods, which seems to be now the big player there. I wonder if that could be a problem, and I wonder how they're competing against Dick's Sporting Goods.
The way I kind of look at it is that sometimes I want to go into just a Vons, pick up what I need, and go out, as opposed to parking way far away at Costco, go all the way into Costco to get one thing, walk through the big warehouse and so forth. So that's why I think Big Five has the advantage that they're not like a Dick's where Dick's are huge.
Yeah.
You got to walk around, try to find something. Big Five, I think they're probably, I would say maybe a quarter the size of a Dick's. So you can go in there, you know what you need, get it, and go out. So different customer. So, alrighty, phone number is 833-288-0973. Gosh, all phone lines are open on a slow Saturday here. You got a company you want to talk about or investment you want to talk about, not sure about something, give us a call, 833-288-0973. Again, 833-288-0973. Right now, let's talk to our financial planner, Harrison Johnson. Going to talk about watch out for income-related monthly adjusted amount. That's a mouthful. Harrison, good morning. How you doing this morning?
Hey, Brent, I'm doing well. How are you doing?
Good. That is a mouthful. Watch out for income-related monthly adjusted amount. Is it short for IRMA?
Yeah, I like that better.
IRMA, yeah. IRMA is a little bit easier to say, and it has to do with Medicare. So with Medicare, everyone gets Part A and Part B, and then from there you can choose, do you want a Part C Advantage plan or do you want a supplement Medigap plan? But everyone has Part A and B. Part A has no premium. Part B does. And if you need a drug plan, that's where Part D comes in, which also has a premium. So Part B and Part D are the two ones that most people have that have premiums, and those premiums change every year depending on your income. So now that we're getting close to the end of the year, it's a good idea to look at what your income or what your AGI is, adjusted gross income, because this year's AGI will determine what your 2024 Part B and Part D premiums are. So you want to look at things like your dividends, your capital gains, if you've done any Roth conversions, what the taxable amount of your Social Security is. All of those things are included in your AGI, and if your income is $1 above the little thresholds for IRMA, your premiums will be increased for both spouses. Now, it's not permanent. If you can get your income down the following year, they'll go back down, so it changes every year. But you want to be mindful of that. So with the income-related monthly adjustment amount, there are 6 little brackets or thresholds that you can fall into, and the first threshold starts at an AGI of up to right now for a married couple it's $194,000, and then $246,000, $306,000, $366,000, and $750,000. So those are the different tiers where if you're above or below that, that's ultimately what's going to determine what those Part B and Part D premiums are. So for Part B, starting next year, your premium is about $165, but depending on where you fall into those IRMA brackets, it could be as high as around $637 per month per person, which, if you're not careful, could result in an extra premium throughout the year for 2 spouses of over $11,000. So it's essentially an additional tax. Any income that you have is part of your AGI, which is a part of your taxable income, which gets applied to the tax brackets. But a lot of people don't look at their AGI as far as IRMA goes, because this is also something that higher levels of income will cause you to pay higher premiums or essentially taxes.
And Harrison, that's one thing I was thinking of. And I know that you look at all this when, if you're financial planning clients, but I'm sure there's people that say, well, I'm just going to do that Roth conversion. I'm just going to go ahead and do that, and I'm going to save money. They probably don't think about that they just destroyed their adjusted gross income, and now they're going to have problems with their IRMA, as we'll call it.
Yeah, it's exactly right, because always when you're looking at Roth conversions, you're looking at what your taxable income is. So taxable income is AGI minus your itemized or standard deduction. So your taxable income is what determines where you fall in the tax brackets, and when you're doing a conversion, you're trying to stay under a certain threshold on the taxable income side. But yeah, many people leave out, well, your taxable income is this, that might be fine, but that's also going to put your AGI above one of these IRMA thresholds, and then 2 years down the road when you're paying your Medicare premiums, you're going to get a little note from Medicare that says, oh, you had too much income, now we're going to increase your premiums on you, and no one wants to get that.
Yeah, and I'm just thinking too, we're very cautious with tax loss harvesting because you can really burn yourself in terms of the lost economic gain. But this could be something too, if you really dial in and understand your finances, or you have a good financial planner like yourself, this could be a reason to maybe take some losses on your stocks just to push that lower, because that could end up, as you said, costing you quite a bit of money. So you'd have to do a calculation to see what the benefit is, but that might be something to consider as well.
Yeah, absolutely. And it's a little bit more difficult because usually throughout the year it's not exactly clear what your dividend income is going to be or what your realized capital gains have been or things like that. So you kind of have to add it up and really compute it, because again, if you're $1 above one of those thresholds, you get hit by it. Unlike taxable income, where if you go above a threshold, only what's above that gets hit. So yeah, you're exactly right, Chase.
And Harrison, this is one reason why we do the things we do at Wills Asset Management. Is that, and I've said there's no way possible that someone can do a good job of managing money and also do the financial planning. Because, and I know there's a lot of guys out there, I'm a financial planner, CFP, I do the management of the portfolio and I do the financial planning. It takes so much time, and you're going to miss little things like this because you're a full-time financial planner, a fee-based financial planner. You can spend the time doing this. If I was trying to do both of these, something would suffer. Either I wouldn't be doing a good job managing the money, or I'd miss little things like this that you pick up on.
Yeah, sometimes it's not what you know that's going to help you. It's what you don't know that's going to hurt you.
Oh, I like that. Well, Harrison, thank you very much for calling in this morning. You have a great weekend. We'll see you on Monday morning.
All right, thanks, guys. We'll see you on Monday.
Okay, bye-bye. All right, again, that was Harrison Johnson, our financial planner. He is a CFP. Again, he's on a salary. He doesn't get paid any commissions for selling a product. If you want a free consultation with him, you go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You can also call the office at 858-546-4306. That's 858-546-4306. Just listen to the prompt for Harrison, and you can actually speak to him right there live.
Yeah.
So, all righty. Phone number's here. Gosh, what a slow day today. It's 8:43. We're three-quarters of the way through the show and only one phone call. But you want to call in, 833-288-0973. That's 833-288-0973. And I'm debating, should we talk about cryptocurrency?
And we talked about it a lot last week, but we can do it again. It's in the news.
It's in the news. And there's one thing, and I was going to actually do a post on this. I'm kind of curious what people think. I don't know if you saw this, but there's actually lawsuits coming out against Tom Brady.
Steph Curry.
Shaq for promoting cryptocurrencies, getting paid for that. Should they be held liable for that?
It is interesting. They talked about how Kim Kardashian got in trouble by the SEC because she did a post promoting that and got paid $250,000, didn't disclose that. I don't know what the rules are for media because they are clearly promoting it.
Right.
But I don't know how much they got paid for the commercial.
Didn't she get paid like $250,000?
That's what I'm saying is She never disclosed. I think you can promote it as long as, I think it would have been okay, like, hey, I'm being paid to promote it. I think that would have been okay, but she never said that.
Right.
My point is, on the TV side, I don't think anybody knows how much Tom Brady made from promoting FTX.
Yeah, and it could be, new grounds going to be laid here because, again, and we all knew it was a hype product and so forth. And they're out there, Tom Brady's going to must be good. He's a multimillionaire. He must know what he's doing. Steph Curry and all the other people. Even what's his name? O'Leary. What's his name? Mr. Wonderful.
Kevin O'Leary?
Kevin O'Leary, yeah. He even got paid for promoting it.
Really? I didn't know that.
Yeah, I saw him on that as well. Well, he should know better, especially him. He talks about dividends and cash flow, but I think he did it just for the money.
Yeah.
And it is terrible because it is now coming out that people are losing millions and millions of dollars. Should these people that you kind of trust because you know them, that's why you did it, should they be held responsible? Because you're right. They did not disclose that they're being paid for it. And the way the commercials looked, it looked like, oh, yeah, you have it. This is a great deal.
And part of me says yes, part of me says no. The reason I say I don't think they should be held liable is just like, come on, really? You're going to invest in it because Tom Brady's? Who cares? He doesn't know anything about investing. And you have to know in the back of your mind the only reason, or one of the only reasons, maybe he's a believer, I don't know, but the main reason I think he's doing is because he got paid a ton of money to do the commercial.
Yeah, exactly.
You have to know that. But, people like to blame other people for their losses. And, I mean, I kind of thought I was funny. I was talking about, you don't see a commercial of, Steph Curry or Tom Brady talking about Apple stock.
Yeah.
Why did they feel the need to talk about cryptocurrency so much? It was just, and what made them an expert, so to speak, that people felt comfortable trusting. And that's where I'm like, well, no, I don't think they should be sued. It was your fault for still buying it. You didn't know research other than, Tom Brady's doing it, I should go do it too.
Right.
That's an awful investment research process.
And unfortunately, people do that.
Yeah, I know.
They don't
and
listen.
that's where I say, I'm like, well, no, it's your fault, but
they don't listen to smart investing shows. So I'm thinking maybe what we should do is on Monday, I'll call Tom Brady. Hey, can he come on the show so more people will listen?
Maybe. Hey, I'm not going to pay you though.
No, not going to pay you. No, sorry, I can't pay you. I can't afford you. All right, let's go back to the phones here. Let's go out to San Diego and speak with Jim. Jim, you're on the Smart Invest Show. Brent Chase, how can we help you out?
Hi, Brent Chase. I'm curious what you think of Biogen at this level right now, please.
Yeah, I know that they had that Alzheimer's drug, which actually did well, then it didn't do well, and then somebody else competing with it. So I'm kind of curious what it's looked like now, because I believe they've come up. So let's take a look at Biogen. Their symbol is BIIB. They are also in the drug manufacturing industry. Only 1.9% float to 88% institutional owned. PE ratio 15.5, not bad compared to the industry at 21.1. Price to sales 4.3 versus 4.2. Price to tangible book value 8.7 versus not material for the industry. And price to cash flow 18.5 versus 17. Now, I do see over the last year their earnings per share climbed by 87.3%, well above the industry at 18.9. They do not pay a dividend. Their sales actually fell by 6.6% when the industry was up 10.8. So I'm not sure how they can grow the earnings when sales are declining. Could have been some accounting there that they did. Current ratio 2.5, better than the industry at 1.4. Debt to equity 0.5 versus 1.6, and the net profit margin 27.6 versus 21.6, and return on equity 22.4 versus 31.7. So all this is looking pretty good to me. What do you got, Chase?
There's a current price here for Biogen, $302.89, at right near the 52-week high of $305.48, and the low, $187.16. And see, year-to-date, it's done well, up 26.2%. I will say, though, it is interesting, going back, looking at like a 5-year chart, when that drug was approved for Alzheimer's.
Was that 5 years ago?
I'm just using the 5-year chart.
Okay.
That's just
right.
There's no 2-year chart. It looks like it was approved in 2021, but it was June. So you look at the 1-year chart now, you're missing it.
Oh,
so
yeah, I see.
in June 2021, it popped up to over $400 a share, and then it got cut back all the way down to $200 a share.
Yep.
And now it's back around 300. So I mean, the stock's all over the place. And one thing that I look at, I was quite surprised by this. The earnings estimates have really come down, and they're expected to continue to fall. Like this year, they're estimated to decline 11% year over year, and then 2023, they're estimated to fall again 8.1% to a target earnings per share of $15.71. And if we use that $15.71 to get our target sell price, we would get, let's see here, $260.79. So it's trading at 19.3 times future earnings. It's expensive.
Yeah.
I wouldn't have guessed that. I thought it was going to be a good deal here.
Yeah, so I mean, it's overpriced at this point. I know they have competition on the Alzheimer's
Eli.
drug. Eli
Lilly, yeah.
Eli Lilly. So yeah, I mean, I'm kind of surprised too. I thought it was going to be coming around 400 plus, but no, it's not a buy, Jim. It's a sell at this level.
All right. Yeah, I kind of thought it might be overpriced, just the fact that it's at 52-week high. I was wondering.
Yep. So.
Yeah. All right. Good enough.
Yeah, and I'm very curious, too, what's going to happen to that Alzheimer's drug, because I know there's a lot of controversy surrounding it. I mean, that is a huge space, and if Eli Lilly or Biogen's able to crack it and actually be profitable in it, I mean, that's going to be a gangbuster drug for them. But
it actually works.
Yeah, exactly. That's the key part there. It's got to work.
Got to work. Exactly. Thanks for calling in, Jim. You have a good one.
Thank you. You too. Bye-bye.
Bye-bye. All right, let's go up to Long Beach and speak with David. David, you're on the Smart Investor. Brent Chase. How can we help you?
Hi, good morning, guys. That Hamilton Beach reminded me of a dividend aristocrat that I've had a few shares of for years, Stanley Works, which used to be Stanley. It's still a Stanley Works, but they added Black & Decker, and it's fallen from 200 to 87,
Ooh.
And they raised the dividend as it was falling.
Mm-hmm.
So I can't understand why it's down so low if they're, dividend going forward raise type of thing, unless they're just doing it for the aristocrat. It normally means they're expecting to still be in business.
And sometimes companies, and we'll look at the numbers here, sometimes they will do it because it's just their philosophy to increase their dividends. They're saying, hey, our earnings are doing well. We're going to increase, reward our shareholders. Even though the stock is down, they're saying the business is doing well. So it could be a great opportunity. I'm kind of excited to look at Stanley Black & Decker. Their symbol is SWK. Only 4.9% short on the stock, so that's not too bad. 92% institutional owned. PE ratio, not that good, though, 21.7, same as the industry, but price of sales is good, 0.7 versus 1.4. Price to book value, 1.3, better than the industry at 2.4. No price of cash flow. They do have a PEG ratio, 3.4 versus 14.8. The lower that PEG ratio, the better, so that's good. Unfortunately, we're seeing earnings fell by 67.2%, the industry down 5.9%. So it appears that perhaps they took some write-offs or something happening there. You want to understand what before you invest in the company. Sales only increased by 0.6% over the past year, but the industry is down 9.8%. And you are correct. They do pay a 4% dividend and only use 33.3% of their earnings to pay that out. So that's a big positive there. We do see on the balance sheet, current ratio 1.2 versus 2.2. That's good. Debt to equity 0.8, slightly higher than the industry at 0.6, but I'm okay with that. Net profit margin 8.3, same as the industry. And return on equity 15.2 versus 17.3. So I'm okay with that. Really comes down to Chase going forward, what they got here.
Yeah, so current price here for Stanley Black & Decker, $80.20. Here's that 52-week high, $196.52, and the low, $70.24. Been hit hard this year, down 56.6%.
Sounds like a tech company.
Yeah, and I'm curious, too, because, I mean, Home Depot and Lowe's, they had some issues in their quarter, but overall it was still an okay quarter for the two of them. I'm wondering... I don't know that much about Stanley Black & Decker, but I would kind of associate it with maybe products that would be sold at like a Home Depot.
Well, and we have a flooring income in our portfolio, which is down a lot as well. So something's not matching up. Again, like it's not 56.6%. I don't understand why.
Yeah, and I mean, the one thing I do see here, already talked about the earnings decline. This year, you're looking at a full year-over-year decline of about 58%. I do see in 2023, you're looking for about earnings growth of 13%, gives us an estimate of $4.96. However, that would just give us a target sell price of $82.34, so right around the current level. Now, one thing I will say is we're now in November, almost December. We're going to be pushing out to 2024. It looks like that estimate jumps up to $7.48, but there's just 10 analysts compared to 19. This may be one to watch at the beginning of next year and could be a good opportunity to get into a business, especially if things look like they're turning around for the company, because that's a huge increase. I do wonder if there's maybe still some work through with the combination with Stanley Black & Decker there. that they're working through some integration costs that may no longer be an issue in 2024, 2025.
Right. And David, you said you hold it or you're looking at buying?
Yeah, I have about 30 shares, and the last time I looked at Aristocrat sheet 2013 is where I had watched it, and then when it dropped this low, so I'm in right around where the price is now, but very little money. But I would, again, everything you said is historically Stanley Works is stable, and of course Black & Decker, which I've seen since I was a little kid. I didn't even know they have any competition really until you just mentioned it, that there's a lot of people in the industry.
Yeah, and also to Roby, I think it is, or Robbie. Or,
I think
I think they're pretty big, and I see them in Lowe's and Home Depot and stuff. So they do have some heavy competition. But Chase brought up an important point, which I'll share with you and our listeners. Is now we begin waiting, because Chase mentioned for 2024 there was 10 analysts, but we wait until they actually report the earnings for December of 2022 to get good numbers for December 2024. So I'd be patient here with this, because that $7 sounds real attractive, but it could come down dramatically by maybe the end of January.
And I just pulled up the website. I forgot they have Craftsman tools now as well.
Oh.
They bought that off of Sears. And so I like this company a lot. And, I know you already own it there a little bit, but I'd be patient for other people and kind of see at the beginning of next year. And as I said, at the beginning of the show, you might miss this one. Right. But I think you might be able to get a steal here if you're patient, just to make sure the numbers are good. And, maybe it goes up a few %, but you still might get a very good value and have more clarity on the stock. I'm intrigued, I guess, is what I would say by this company.
And this is the company we kind of like as well. And I remember Craftsman, I don't know if they still have it. They had a lifetime warranty on their tools. You broke a tool, you go back to Sears, they replace it. I assume they still have that. But I like this company. So
Sears, as they were going down, they dumped Craftsman. I can't remember. Is Stanley the one that picked it up?
Yeah. Stanley owns Craftsman.
Yeah. So and Sears sold it for the money, obviously. But I'm wondering if Stanley kept that lifetime warranty on the tools. I'm assuming they probably did, but I don't use my tools that much, so I don't break them. David, thank you for calling in. So stay patient a couple months and see what happens. Give us a call back. We'll say first part of February. We can look at it again for you.
Sounds good. Thank you.
All right, thanks for calling. Have a good one. Bye-bye. Alrighty. I'm sorry, Michael. We ran out of time. Everybody called right at about 8:45, so we got people to call a little bit early, around 8:30, so we can get more calls there.
I know, and I was curious because I talked a little bit about Williams-Sonoma earlier.
Yeah.
It is actually one that the numbers look pretty good on it, and it honestly might be better because I think they just reported, so we might get even better numbers next week. So might be a blessing in disguise for you there, Michael.
Yeah, Michael, call back next week. Call around at 8:30.
Yep.
Yeah. So that's when we can talk more about it. So great show today. A lot of good things we covered. I think a lot of information for people. Can't wait till, although next week, I think next week we're going to do the educational show because it's Thanksgiving.
Yeah.
So we're going to do the educational show to kind of, and tune in for that because you'll really learn a lot of details of what we're looking at. And then when we come back 2 weeks, you'll understand more about what we're looking at. It'll make you a smarter investor. I mean, we do that show to really help you understand. We do it a couple times a year to try to help you out there a little bit. So that'll be next week, the Smart Investing Show, the educational show, as we call it. We go over all the details, why we look at these current ratios, why we look at the valuation ratios and so forth, and really help you understand what's going on with it.
Yeah, there's a reason why we do these things. It's not just because, maybe it'll help. It's really useful to understand why we do what we do and how we do it.
Yeah, and it takes all the emotion out of it. I mean, we don't get excited about things, and we do get excited. We get excited about.
I'm excited about Stanley Black & Decker.
Right.
I mean, it looks interesting.
But not excited about the stock price. The stock is going up. Now it's going down. Yeah, no emotion. All right, there's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And be sure to visit our website, smartinvesting2000.com. That's smartinvesting2000.com. A lot of great information there. Sign up for the newsletter there. And also, too, for more daily educational information with investment tips, go to our Facebook group page, Smart Investing with Brent and Chase Wilsey. Thanks for listening to Smart Investing Show. Have a great day. We'll talk next week.
I did all that